everyone, how about that Starbucks stock? Many of you know that I own Starbucks. I purchased it 30 separate times throughout 2020. I purchased it in the 50s, the 60s, the 70s, the 80s, and even the 90s. This doesn't even count my reinvested dividends, and I'm doing that as well. What's so exciting is late last week, Starbucks announced during their analyst day that their earnings are going to be really solid and that they're going to be really solid in the next few years. They announced that in fiscal 2022, earnings are going to be up at least 20%. They announced that in fiscal 2023 and in fiscal 2024 that earnings will be up 10 to 12% each year. On this news, the stock price surged. It's up at a new all-time high. I'm really excited about this in some respects, but not in others because I'm a long-term dividend stock investor and I prefer to buy when share prices are low. So needless to say, I'm still reinvesting dividends, but I'm not buying Starbucks stock right now. The purpose of today's video is to share with all of you 3 stocks that I am buying right now. 3 stocks that I feel kind of like they're Starbucks when I was buying it back a while ago when it had a little bit more value to it. And so these are the 3 stocks I'm buying right now. And in fact, these 3 stocks, I purchased all 3 within the last week. And so the first stock that I want to cover today is Campbell Soup Company. And so many of you are familiar with their most iconic brand, which is basically this particular soup right here, the Campbell's chicken noodle soup. World-class, iconic brand, full of salt, really good for all of those of us that like to run and need some salt after the run to recover from it all. But you may not know, they also produce a variety of other products, consumer packaged goods products that I actually really enjoy. I'm going to show you some of those right now. And so one of them is this goldfish. This is the big box. This is the one that we get at Costco that has so many goldfish in it because our whole family, both adults and both kids, love goldfish. And so these ones are really good. And these are also full of salt. Very good for someone like myself who likes to run long distances. You may not know that the Campbell Soup Company also produces these plum bars and pouches as well. These are really great for kids. These are really good products for kids. And so the Campbell Soup Company also, they make a lot of pretzels. Oh, this one actually, shout out Frito-Lay. This one's made by Pepsi, but I own those guys too. But their competitor, Snyder's Lance, that one is owned by the Campbell Soup Company. So I'm going to cover the Campbell Soup Company in today's video because the PE is a 15 right now. They just raised the dividend. They are transitioning from a period when they had poor management. And now they have good management. They've divested some bad acquisitions. I think their product portfolio is very well positioned as compared to other CPG food companies. So I like them very, very much. I also want to cover in the video today my #1 favorite dividend stock of all time, Johnson & Johnson. Even though it's trading upwards of $150 now, in the scheme of our overall market, I really like J&J now, and you're going to see why. I'm going to do some balance sheet analysis as well. You'll see how pristine their balance sheet is. And the third stock that I purchased just within the last week, I actually purchased it twice, and I purchased it as the Christmas present for both of my kids. Now, this is a stock that's not on sale. J&J, Campbell's Soup, I look at those like they're on sale. I look at those like I looked at Starbucks a few months ago. Not when Starbucks was in the 50s, but maybe when Starbucks was in the 80s or the 70s maybe. Surely not the 50s. That was just fire sale Starbucks. But the third company, the Hershey Company, this is my Christmas present to both of my kids. I want to talk about that in detail in the video today. I recently analyzed this stock on my channel, and I'll show you something interesting. They make this product, Pirate's Booty. You may think Hershey Company, it's just known for the chocolate, and their chocolate is world class. But you may not know they also make products like this, Pirate's Booty. This stuff is so good, this Pirate's Booty. Again, really good snack for kids, adults too. We love it. And I'll tell you, you may not know, but the Hershey Company also makes this Skinny Pop popcorn. And this is a good, healthier snack. I think it's only 100 calories total per bag, so not bad. Some popcorn there. And so I'm going to cover the Hershey Company in the video today as well. I like to look at all three of these companies as pandemic-proof companies, if you will. These are companies that will thrive in any kind of market, and I am excited about all three. So let's get started with another exciting dividend video. And before I do, everyone, please smash that like button, and I'll tell you why. I recorded this entire video last night. I did not like how it turned out, and so I decided to re-record it again. I guess that is the life of a YouTuber. And I want to share a quote on the screen with you all right now. Check it out. This is a quote from Jay-Z from his track So Ambitious. And he says, "The motivation for me is them telling me what I could not be." Jay-Z receives a lot of motivation, and he did receive a lot of motivation through the haters, through the skeptics, and look how far he has come. I am here to motivate all of you. I am here to motivate the dividend investing community to achieve excellence, and that's why I refilmed the video today, because I need to bring my best work to all of you. Please smash the like button. I love you all. Let's get started with the video. All right, everyone, let's start with the Campbell Soup Company. I want to share that on the screen right now. I want to talk about some of the bullet points that you see on the right hand of the screen first. What do I love about this company so much? One of the things, first and foremost, that I love so much is the fact that it flies under the radar. So many dividend investors, so many analysts, they don't talk about this company quite as much because it has a smaller market cap. This is a company with a $14.3 billion market cap, as you can see on the screen. So it's a smaller company. It doesn't get talked about quite as much, but their portfolio, as I illustrated to you in the introduction today, it really is world-class, especially now that they cleaned up the portfolio. They got rid of some of those bad acquisitions. They fixed things up. They have so much exposure to the snack food category, which is a really fast-growing category. They have exposure to all of the treats and snacks that we like to enjoy at home or at work during these stressful times. I think there's a resurgence in this category, if you will, because of the pandemic. And I would say these types of companies are the unsung heroes of the pandemic. They allow all of us to have the food and nutrition, the snacks that we need during these tumultuous times. And so I love these types of companies, but I especially love Campbell Soup because it flies under the radar. And as you can see on the left-hand side of your screen right now, it's trading at a PE of 15, and so it really is flying under the radar. They actually just raised the dividend. This is not a company that increases the dividend all the time, but they do it a little bit haphazardly. That's one of the things I don't love as much. That's why I say it has slow and inconsistent dividend growth. Needless to say, though, the 5-year dividend compound annual growth rate is a respectable 3.5%, and with their 49% payout ratio, they surely have room to grow that dividend. They are paying out less than half of their earnings per share as dividends, and so that is leaves a lot of room, and it has a solid starting yield of 3.15%. As someone who doesn't look to retire tomorrow, I'm already using some of my dividends to pay bills, but largely speaking, I'm in a busy time of my life right now. I discussed this in my last video, which is a day in the life of me. Check it out. I'll link to it in the description below. But I'm in a busy time of life now. I have 2 kids, and whether I take an early retirement or semi-early retirement or not, what I've kind of concluded is I'm going to be busy regardless, and so because of that, I'm just going to hustle. I'm just going to keep working. And so it's a busy time. And so what I'm saying is I don't need my dividend cash flow immediately. I can stand to invest in companies with lower dividend yields that grow quickly over time. That being said, I surely like options, and I do like current cash flow because life changes. I never know what I'm going to do, and I am already using some of my dividends to pay bills. And so Campbell Soup, it's in that sweet spot. Dividends not too big, dividends not too small, has room to grow it. Company itself is repositioned for growth, and so I like all of that. Now, what else do I like about this company? Check it out on the screen. What I like is they acquired Snyder's-Lance. This is one of their better acquisitions, and so I goofed up in the introduction and showed you guys the rolled gold, but rolled gold, I guess, is a Frito-Lay product. I own PepsiCo too. That's my number 2 favorite stock of all time. I love them. But Snyder's-Lance is that iconic pretzel brand that was acquired by Campbell Soup Company, one of their better acquisitions. They own Pepperidge Farm, which makes Goldfish and all those delicious cookies. And what I would say that you can also see on the screen right now is the management change worked. I actually really liked their last CEO, but unfortunately that CEO did not work out, and the acquisitions that were made, not all of them were really good. And so it seems like the new CEO, the new strategy is working. The company is repositioning itself for growth. And I kind of look at this like I looked at Starbucks back and say, not the 50s or 60s, that was just deep discount, but even the 70s. I knew from kind of field research that the growth was coming for Starbucks, but I also knew that the street wasn't fully reflecting that yet. The stock price wasn't fully reflecting that. And what I see with Campbell Soup, again, just from my intuition, is they've turned this thing around, but the street isn't appreciating that yet. The PE of 15 doesn't appreciate that yet. And that creates a lot of opportunity for long-term dividend investors like myself to buy at a solid share price. And so I really like buying Campbell Soup here. I just bought some, as you can see on the screen right now, at $47. And I will probably add more shares throughout the next few weeks in December and also looking into the new year. All right, everyone, I want to move now to Johnson & Johnson. This is my #1 favorite stock of all time. Check it out on the screen right now. I don't have any fancy props for J&J today, but I think their numbers will speak for themselves, especially when you see their balance sheet. It's my #1 favorite stock. And one thing I have to remind myself as a dividend investor is sometimes it's okay to add to my largest position. In fact, it's really good to add to my largest position. Sometimes it's boring because this position is so large, and when I add incremental money, it doesn't make a super large position that much bigger, but I have to get over that. I have to get beyond that. I have to remember to add to this one because it is so solid. Everyone needs health care. We've learned that this year, especially in 2020. And I would say one of the things that really surprised me the most, as you can see on the left side of the screen through my analysis, is that the 5-year dividend compound annual growth rate is 6.1% on average. I actually did not expect this. This was a bit higher than I had recalled. And so I highlight that, and it's so exciting to see a dividend growth rate that high for a company this big, which is a $400 billion company. This company tends to grow through acquisition. They're really good at that. They've perfected that. But what's so interesting is their balance sheet does not carry much debt at all, nearly none for a company of this size. And it just shows how effective they are at the acquisitions, how effective they are at managing their cash flow, their balance sheet. This is a really well-run company. This is not a get-rich-quick overnight company, but it offers stable growth both at the top line and eventually at the bottom line as well, which is so exciting to see. What else do I like about this company? I really like that it is a mutual fund of sorts. It's a diverse healthcare business that offers consumer medical devices and pharmaceutical products. I really like that it has an international focus as well. 49% of revenues from their 2019 annual report come internationally. I would say, just like Campbell Soup, this is pandemic proof in many ways. They're doing share buybacks really well. We'll see that later. They're not taking out debt to do it. They're doing it through cash flow, which is the right way to do it. And that being said, there are some things that I don't like about this company. I would say there's 2 things in particular that put my #1 favorite stock of all time at risk. And one of those are the lawsuits. We know that there have been some lawsuits around the talc powder, for example. And my heart goes out to anyone who alleges from the Johnson & Johnson company that they are affected negatively by their products. The way I look at it is I leave it up to the courts. I leave it to the legal system to decipher what is the best course of action for those cases. But just from a pure investor standpoint, I do have to realize that this type of industry, the healthcare industry, the pharma industry, it carries a little bit more risk than selling goldfish, for example. And so that needs to be priced into the investing strategy. And as you can see on the screen right now, that's probably why it's carrying a PE looking forward to fiscal 2022 of 16.99 on my recent purchase price of $152.95. That's a really low PE for a company of this caliber, and it's probably because of some of the risks out there, which also include political risk as well. We know there's some political risk with this company because the healthcare system in the U.S. is broken. There's a lot of room for improvement. And as politicians get involved in fixing this system, my question becomes, how will that affect J&J? Will it be positive? Will it be negative? I would say there's more risk than upside, and I think that's also priced into the stock. That being said, in the market we're in, given the size of the company, given the quality of the company, I am surprised that J&J is trading at these levels. And for that reason, I will keep buying in December and also into the new year, into 2021. This is my number one favorite dividend stock pick of all time. And with that, check it out on the screen right now. I want to do a quick balance sheet analysis. You can see from their 2019 annual report on their balance sheet. I'm going to go really quickly, but what I really wanted to show is under liabilities. Kind of go down the screen and look for current liabilities. Loans and notes payable, only $1.2 billion. It looks like current liabilities are just really low. If you look in there, there's not a lot of debt. Total current liabilities are only $35.9 billion. For a company of this size, not very high, especially when you look at current assets at $45 billion. Now look at the long-term liabilities. Long-term debt, in particular, is why I'm showing this screenshot. It's only at $26 billion. And total liabilities are only at $98 billion when their assets are $157. Now, those assets do include some intangibles and also some goodwill. I imagine that is largely coming out. Well, I know the goodwill out of their acquisitions. I imagine the intangibles as well. And I would expect that for a company that grows through acquisition. I would say maybe I discount that goodwill and intangible assets a little bit, but needless to say, this company is managing the balance sheet well. This company has very little long-term debt for a company of its size and a company of its scale. This is a company that I really respect from a balance sheet perspective. And with that, let's look at the earnings really quick. Again, this is from the 2019 annual report. And when I look at the earnings, you can see top line sales are steadily growing. 76 billion, 81 billion, 82 billion, steady growth. And gross profit, similar, 51 billion, 54.49, 54.5, not growing quite as quickly, but it's growing. Net earnings, it jumps around a bit more from 1.3 billion to 15.29 to 15.1. In the short term, sometimes net earnings can be wacky, especially on a GAAP basis, generally accepted accounting principles, because there are tax code changes. There are certain effects that can go in that skew these numbers in the short run. And so oftentimes I like to look at an adjusted earnings per share. But what I like seeing here, just looking at GAAP earnings per share and GAAP income statement, is the top line growth most of all, because the bottom line will follow. And when I elaborate and I look at the statement of cash flows, which I'll show on the screen right now, it helps explain as well some of the earnings, net earnings fluctuations here on the income statement. So check it out. And what you see right now on the statement of cash flows, I like to look at that net cash flows from operating activities. It goes from 21 billion to 22.2 billion to 23.4 billion. So steady growth. And what I also like to see is, as I look lower on here, it has repurchases of common stock at 6 billion, 5.8, 6.7. So they are buying back common stock, but their net cash and cash equivalents is largely similar throughout the years. It's not fluctuating too much. And so they're not taking out of that cash, for example, to buy back shares. And we know that their long-term debt is very low. And so certainly they're not taking out egregious amounts of debt to buy back shares either, from my vantage point. And so I really like J&J's statement of cash flows. I think it's a pretty solid statement of cash flows. And this is the reason, quite frankly, this is my number one favorite company of all time. The numbers just look awfully good. And so I don't have a cool prop to share on J&J, but I think the numbers speak for themselves. With that, I want to move in to my third stock today. This is the Hershey Company. Now, this one is a little bit different. First two I bought in my wife and my account for our accord. But for my kids, for the Christmas holiday, I like to give them the gift of stock. And so they both now own the Hershey Company. And the reason I bought the Hershey Company is I had been buying them the Disney Company for all of these years, but the Disney Company suspended its dividend. And being a dividend stock investor, I prefer to purchase stocks that pay a dividend. Now, have I sold the Disney company for them? Absolutely not. And I'm glad I didn't, because it has been actually recovering quite well and surging in share price. That is really good, and I'm happy about that. And quite frankly, I think at some point in the future, the Disney company will bring back their dividend. And for my kids, I can't imagine they start tapping into these dividends anytime soon. It's going to obviously be decades into the future, and I'm modeling out some scenarios for them. I'm kind of looking, hey, maybe if they start tapping into dividends a little bit when they're in their 40s, you know, that's 40 years from now. And so basically 40 years from now, I imagine the Disney company will probably bring that dividend back, and the yield on cost will probably be really great. And so that's how I'm looking at Disney. I still like it for them, but certainly Disney is not the kind of stock I could ever buy for myself, because for me, someone that's already using dividends, that will use it more and more over the next 2-3 decades, especially even 10 years out, I'll be using dividends a lot more than I am now. Disney company is not going to get there for me, not on my time schedule. And so one thing that I think is a takeaway here is that you should assess what your time schedule is. Different investors are at different stages. Younger investors can compromise on short-term dividend yield for the long-term yield on cost and the long-term growth. But those dividend investors like myself, who are already living off of dividends a little bit and want to do so increasingly over the next decade or so, time frame not so long. I can't wait around long enough for Disney, and quite frankly, I can't wait around long enough even for the Hershey Company. But I bought the Hershey Company for my kids because, one, it's a brand that resonates with kids. Two, they have such a solid product portfolio and solid numbers. But three, they got time on their hands, and so it's a perfect stock for kids in my humble opinion. Check it out on the screen right now. What are my favorite things about the Hershey Company? I love their margins. They are very strong. The products that they produce are not very expensive to produce or market, quite frankly, and so their gross operating and net margins are strong. I will link in the description below, because I recently did an analysis of this company that proved just that. Their dividend is growing at a strong 6.6% compound annual growth rate for the last 5 years. We love Pirate's Booty and Skinny Pop as well. It has a sleep well at night factor. This company is not going anywhere. It is pandemic proof in my opinion, and kids, adults alike, always like to enjoy some chocolate, both in good times and stressful times as well. I know this holiday season, this Christmas season, boy, we're already all over the chocolate, and so I need to run a few extra miles to run that all off. Let's keep going. And so what don't I like as well? Well, it has a low starting dividend yield, which would totally rule it out for me. But again, well, I wouldn't say totally, but I've got enough stocks in my portfolio that are kind of lower yielders, high growers, that I don't need another. But my kids totally works out well. Premium valuation right now. Campbell's Soup, J&J are on sale right now. Hershey Company is not, but this is another very critical takeaway. I'm building a portfolio or portfolios for my kids. Their time frame is very long. I have a lot of younger investors here on the channel as well. For people whose time frame is really, really long, I don't really think it's always good to buy value, and I always try to buy value. But what I'm also saying is, especially for someone with a really long time frame, quality and selecting the right stocks, in my opinion, always trumps value. And so I think that's just something really important to consider for those with a really long time horizon. Now, personally, I own 47 quality stocks in my portfolio, and at any given time, some of them are on sale, like Campbell's Soup or J&J, and so I just kind of go where the value is within the quality. But I am looking at things a little differently for my kids because they have that time frame. Let's keep going. So what else? Sleep well at night factor. What else I would say I don't love? U.S.-centric business. It could use a little more international, and hopefully they grow the international exposure over time. I bought the shares at 150.35. Current PE is in the 24s this year, 22s next year. Smaller market cap at 31 billion, which I really like, although not as small as Campbell's. One thing I would say all three companies today that share in common are payout ratio right around 50%. This one for Hershey's is at 51.7. I really love that. These all three have really solid payout ratios. And as you can see on the bottom of the screen, I did a really quick yield on cost analysis. This is simple yield on cost. This doesn't count reinvested dividends. But for my kids, when it's kind of 40 years from now, maybe in like 2060, and they want to tap into their Hershey dividends, the simple yield on cost, not even counting reinvested dividends, should be somewhere around 28%. Somewhere probably more like, between 20, 28, definitely at least 15%. And so it all depends if they can keep this dividend growth rate up. I think they probably can, but time will tell. I mean, 40 years is a lot of time. And so it'll be somewhere probably between 15 and 28% on cost, not even counting reinvested dividends. And so I like to buy a dividend grower for my kids because they're in that bucket where they have the time. And so I hope you enjoyed the 3 stocks I shared today. I love all 3 for December, for January, for different reasons, obviously. Please smash that like button if you enjoyed the video today. Comment below. Please subscribe. I love all of you. The amount of work that went into this video was tremendous in that I not only researched all of this, but also filmed it twice. Oh my goodness. And so share a little extra love if you have a minute with those thumbs up. I am on Patreon. I have 12 bonus videos there for my patrons and counting. I'm adding more and more bonus videos every week. I love the patrons. I love you all. Thank you for your support. Before I leave today, in terms of full disclosure, I own the stocks mentioned today. I am long PepsiCo, ticker symbol PEP, Campbell Soup, ticker symbol CPB, Johnson & Johnson, ticker symbol JNJ. I am also long Starbucks, ticker symbol SBUX, and my kids are long Disney stock, ticker symbol DIS, and the Hershey Company, ticker symbol HSY. Before I go today, in terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market, please consult a licensed investment advisor first. Losing money in the stock market is very possible. I'm just sharing my personal journey here on YouTube for fun and entertainment. Thank you so much, everyone, for your support. Happy holidays, Merry Christmas, Happy Hanukkah, Happy Diwali, all of the other holidays, Happy Kwanzaa. I love you all. I will see you in the next dividend investing video.